Lynch joins in with his view. Indranil, hi, good to see you in today. We are already at the lowest level since September 2013 for the rupee. So in your opinion, do you think that the worst is already factored in and we factored in the Fed rate hike for the rupee, or is there more weakness that we can see?
Well, we do think that the worst is over, and we were talking of three event risks. One was Bihar, the other is the Fed, and third is a turnaround in earnings. And with the Fed done and earnings presumably turning around, flows coming in from a seasonal perspective, FPI GSEC investment hike from January 1, we think the rupee can roll down to 65 by March. So we think that, in the fourth quarter, the rupee will gain because of all these three factors.
Okay, Indranil, hi, morning. That's a brave call. What's your biggest risk factor to your call on the currency?
I think the biggest risk factor is if there is a major appreciation of the dollar. I think the issue is that, the market is largely pricing in 2 Fed hikes next year. The Fed dot plot suggests 4 to 5. So I think the important thing to see is, does the Fed come in and look as if they are being dovish, supportive of growth, or do they look like hawkish? So that's one risk that we'll come to know on Wednesday night. But apart from that, clearly seasonality is on the side of the rupee. Like I said, investment hikes will happen for bonds, and earnings should begin to turn around from the December quarter.
You said 65 by March 2016?
Yes.
Okay. Do you think that we could touch our record lows or play with 68 levels before that?
Well, on the momentum, anything is possible. But the fact of the matter is that, maybe the dollar is now overvalued by, anything between 15 to 20%. I mean, I would put the fair value of the dollar anything between 120 to 130 a euro. And similarly, the rupee is undervalued, not in terms of the RER, but purely in terms of the dollar cross. The rupee's fair value is probably somewhere between 55 to 65. So while, momentum takes you, sometimes to 68, it sometimes takes you to 55. Somewhere, I think the rupee now has the support of valuations.
Okay. What's your sense, Indranil, then, in terms of flows? What could we see in terms of resumption of maybe FII flows into equities, something more sustainable in the debt markets?
Well, we think that, there are going to be 3 phases. Like I said, that we were saying that flows would dry up in, end 2015 because of these 3 factors. Again, flows should resume now. Maybe end of the year again, maybe a tough, third quarter, the last quarter of 2016 will be tough for flows because, there's going to be a change at the RBI or not. There, at least $15 billion may flow out because of FCNRB flows, deposits maturing. There will be this entire FX repayments build up and by banks and corporates, and finally there will be the uncertainty because of the UP polls. So just as you had a phase of event risks which dried up flows now, you might get a phase of event risk which dry up flows towards end 2016. But I think somewhere between January, February to August, September, we do see flows resuming.
Okay. A final question then, Indranil, what are you factoring in terms of the RBI action for next calendar year in terms of further rate hikes, or rate cuts rather?
Well, we are looking at a final rate cut on February 2 and then a long pause.
Okay, a final rate cut and quantum, 25 basis.
25 bips.
Okay, 25 basis points on 2nd of Feb, and after that a long pause is what you're expecting from the RBI. All right, Indranil, we're going to leave it on that note. Thanks very much for joining in and talking to us. Well, on that note, we're also going to wrap up this edition of Trading Up, but stay tuned. Halftime